Scott O'Neill is one of Australia's most influential voices in property investment and is transforming the way Australians think about building wealth. A former civil engineer turned self-made investor, Scott achieved financial independence by the age of 28 by turning his passion for property into an expansive portfolio and a thriving business empire. Today, he is the founder and CEO of Rethink Group, a diversified multi-brand powerhouse that has guided over $5.8 billion in property transactions across Australia and New Zealand. Scott is a best-selling author, sought-after speaker, and trusted media voice. Known for his sharp investment strategies and visionary leadership, he has a unique gift for simplifying complex financial pathways and showing everyday Australians how to create lasting prosperity. Scott's hands-on approach, deep market insight, and relentless drive for excellence have positioned Rethink Group as one of Australia's most trusted and progressive investment partners. I'm super excited for our conversation, and it's an honor to have him on the show. He's joining us today from Sydney, Australia. Welcome, Scott, and thanks for joining us on Life Excellence.
Great to hear, Brian. Thanks for having me.
Well, it's great to see you. Scott, you and I met on Necker Island earlier this year, and I've been looking forward to the show ever since. What stood out for me immediately in our first conversation, even before we got to Necker, was the speed of your success. First, investing on your own and becoming financially independent, and then, of course, with the phenomenal growth of Rethink Group. You started your career, though, managing construction sites as a civil engineer. How did you get started in real estate, and what caused you to eventually leave civil engineering to become a full-time investor?
Yeah, look, it surprised me as well, the speed of things that happen, because by nature, I'm pretty conservative. Like, I guess my parents are sort of accountants and draftspeople by trade. So we're really kind of like that middle class, like work till you're 65 notion, and that's sort of what I was gearing up towards. Like I did a civil engineering degree, thinking I was going to be an engineer forever, and then a couple of years into that, I realized you needed a bit of business there, so I started doing an MBA. So I was really gearing towards the hopeful CEO trajectory with a large company. So what I didn't really anticipate is how little I liked working at these construction sites, because as an engineer, you've got to gear up and move every 2 years on average, maybe every 3 years, because you've got to chase projects around the country. Australia's a big country as well, so that means you're probably going to have to move thousands of kilometres, or if you're lucky, stay in the same city, but you might be driving 2 hours on top of 12-hour days as well. So I was really disheartened by, I guess, how hard the long-term trajectory looked, and the pay was good. Like, as an engineer, I can't lie about that. But it was really, I didn't think it was equal to the amount of hours and skills we had as well. And the career progression was quite linear as well. So you had to be a graduate engineer for a couple of years, then you're a site engineer for a couple of years, and then a project engineer for another couple of years. But I guess the system is designed to keep you working long-term under a company structure that kind of, I guess, progresses you moving faster than you should. So it's not so much skill-based, at least my experience wasn't. It was really timeline-based. And as long as you ticked enough boxes, you'd progress to that next timeline. And as soon as I worked that out, I was pretty adamant to do anything I could to, I guess, bring retirement quicker. And that was investing on the side. Like, I started investing in shares from the age of 14. I was very young into that. I was only playing with, a couple of $100 here or there, through, whatever I could sort of scrounge up through part-time work. I worked at McDonald's as soon as I was legally allowed to as well. So I was always a worker, I guess. But where it really changed was getting into real estate, because in Australia, we could leverage up. Like, I put a 10% down on a property. So, that means you're playing with 90% of other people's money, which is the banks in my case. And it started fast tracking the returns. And I guess that's how I got started. So I was 23 at the time of the first purchase.
What was your first investment property, just out of curiosity?
So it's a really simple house with a granny flat on it in Sydney, not far from where I lived. I live in a place called the Sutherland Shire, which is, I don't know, 45 to an hour south of the CBD of Sydney. And the property it had good cash flow. In Australia as well, like there's this trend towards taking a cash flow loss on your properties. The reason for that is there's a tax deduction on it. So there's this culture of accepting negative cash flow, and that is the goal with the hope of getting some of the tax return back. But the problem with that strategy is you're not actually building an income that you can retire from. It's just all for capital growth and nothing more. And hopefully the cash flow fixes itself in time. And I grew up in a cash flow poor household. You know, they had assets, my parents, but we really didn't have free cash flow. And I just thought that way of living is counterproductive, especially if I wanted to get out of my job or work a different one, maybe a lower paid one that was more lifestyle focused. But I guess my property, because of the granny flat, had extra income, and that allowed it to, wash its face from a cash flow point of view. It was actually about 10 grand clear per annum, so $10,000. I looked at as a pay rise. Thought if I could buy 10 of those, that's 100 grand a year. It's a pretty good start to retirement. So that's kind of got me. I guess that was the foundation to the initial investment strategy.
Well, it sounds like a great start, especially from a cash flow standpoint as it compares to what most other people were doing. Scott, I know one thing our listeners are wondering is how you achieve financial independence by the age of 28. I think a lot of people, maybe 38 or 48 or even 58, would like to figure out how to do that. How do you define that, first of all, financial independence, and walk us through what you did to get from that first investment property to that status financially at such a young age, especially?
Yeah, so financial independence for me is simply having enough cash flow from your investments to live off, so you don't require a job. And that's what it was for me. I replaced my income at the age of 28, and it was a pretty good income. Like I was working in, like you said, a construction engineering business. I had 130 staff and contractors working for me at a young age, and you could imagine the income was pretty good from that. But I used that income to kind of deploy every cent of it, to be honest, back into property. I was living in a very cheap rental. We would basically just redeploying all the capital we could back into property. The thing I did differently to others was there was a few things: chasing cash flow and capital growth. I was never neglecting one category over the other. Most people choose capital growth or cash flow. I wouldn't touch the investment unless it had a strength in both columns. So that's more of a long-term strategy that kind of underpinned the success of each investment. What I did differently to others was I started buying unit blocks on one title, strata titling them. So let's say there's a unit block, you might call it multifamily in the US or something like that, but I would then buy them on one title and then split them into 5, 6 titles. That would then create a revaluation uplift, because you can, it's like cutting a pizza up into 6 slices. They're worth more per capita on slices than they would if you're buying the whole thing yourself. So I was buying it at a discount and then going to councils, doing some renovations, fixing the places up. I was very hands-on as well. I was, doing everything from floors to kitchens to, organising new car parks to get done to increase the lettable area of these properties. So it was fairly, I guess, manual, and also a little bit technical because of the change of ownership structure, which really created nice equity chunks that I'd then redeploy into the next project. So from the age of 24 to 28, I did a lot of that. Australia's property market was just going up and up as well. So naturally, things were very good, just because real estate in Australia is, it's all but bulletproof, because we've got this amazing lever called, well, it's amazing, well, it's not amazing depending who you are, but as an investor, immigration solves all our economic problems. Like, we've actually been in a per capita recession for the last couple of years, but if you let enough people in with money, GDP increases, and that's sort of what happens. And we're not building enough houses in Australia, so this is a real problem if you're, say, one of the younger generation or you're trying to get into the market, because they're effectively pricing them out because we're not building enough and there's just more and more demand And there's a lot of people like me that, we're just playing with the system we're given. We're not causing the problem. We are literally just buying and we're providing rentals to people. The natural market just keeps growing. And so it's a great place to invest. It's a safe haven. Same with New Zealand as well. It's a little bit more volatile there, but they can just, they've got the immigration tap benefit as well. Then moving into commercial and the numbers in that department were just next level. And that's sort of what kind of fast-tracked the income side of things.
I know you've been doing commercial for quite a while now, commercial and industrial properties. You wrote a book about it. Do you see yourself as a pioneer or at least a contrarian from that standpoint? I know it sounds like maybe you're still doing some multifamily residential, but I know a lot of what you're working on, both for yourself and for your clients, is commercial.
Yeah, look, I'm definitely one of the biggest voices in Australia, especially in the last 20 years. Like after the GFC, people forgot about commercial, and rightly so, because a lot of the commercial markets corrected 30-40%, like the office market particularly. That subprime crisis really affected commercial landlords with debt at the time. I always studied previous economic issues so I could avoid them in the future. And every economic issue is different as well, but you can learn from the patterns. And I just sort of saw all these properties around Australia well below replacement costs. And, anyone would have done the same thing in the US and some markets. So you get in after the correction. A lot of these people make the mistake of buying at the peak, and, that's when the yields are at the lowest point, and there's, obviously cash flow issues and valuation problems that happen from that. But I just saw it was a really cheap market and no one was looking at it outside of maybe owner occupiers and the odd, I'm generalizing, the old guy in their 70s or 80s who've got a big industrial complex that they've held for decades. Like that was almost the demographic. What I've done in Australia is really started speaking about it just through my own personal experiences. Like I bought this shopping centre, I bought this industrial property, here are the numbers on it. And just by talking about it in, on podcasts or in the books you mentioned, people were just like, well, the numbers are good. It feels safe because a supermarket feels like a good investment because there's a 10-year lease. Like all of a sudden people realized it wasn't the boogeyman everyone's making it out to be. The numbers are good. It's still a physical property. It's freehold land. You could change its use if you needed to. Like it's a valuable asset in a good market. And the numbers were just too good. So the more we talked about it, the more awareness became. And Australia's like the residential market's about 12 times the size of the commercial market. Plus, everyone understands residential. So that's where everyone talks about it. Like we in Australia say this saying, it's like the famous barbecue topic. Everyone has an opinion on residential property because we live in it. Everyone feels like they're an expert on it. As soon as you start talking commercial, it's crickets. No one knows what's going on. It's kind of like this grey zone in the economy outside of major fund manager owners who own towers and stuff like that. Beneath that, it's kind of forgotten. So I feel the gap will started to in Australia, and we've influenced thousands and thousands of investors to consider and buy in this asset class.
Do you feel like that gives you a competitive advantage when nobody's talking about it? I know you and I talked about this a little bit. In the U.S., it's the same way. People who are talking about real estate, even real estate investing, tend to be talking about residential, single-family homes, multifamily apartment complexes. There just aren't a lot of people talking about commercial property investing, and yet there's so much of it, whether it's retail or medical or office buildings or childcare centers or even parking lots. So does that help you from a business standpoint?
Yeah, definitely. Look, the people in the know commercial. Like if you look at any good family office around the world, they've probably got a large portion of their net wealth in commercial property. It's whether it's shopping centers or medical centers. And I guess humans are negative bias as well. So people will go, oh, commercial, it's crashing because they think, oh, because the San Francisco vacancy rates are super high, that reflects the entire industrial market or the medical field or the, like what's the pharmacy got to do with a high-rise apartment in the city where there's too much supply? The answer is very little. In fact, COVID actually brought a lot of opportunities to different, I guess, segments of the market. Like industrial is one of the fastest growing sectors of the economy because so much is like the e-commerce boom keeps marching on, and that directly means there's more need for storage, logistics capabilities, even everything that's happening around the world with almost a decentralization of things means more local manufacturing is coming back online. Like, so if you understand how to read the commercial markets, it's almost, I think it's a lot easier to make money than residential, because residential is almost like a blanket homogenous product that goes up and down depending on what sentiment and interest rates are doing. But commercial, it's like stocks. There's certain sectors that are going to go well, and if you're in the know, you will pick them easier. And there's certain sectors that are going to go very poorly, and that's exactly what's happened in the case of the office market. And so you just got to avoid those areas and pick the winners, like anything.
Yeah. You started your company, Scott, Rethink Investing, the first company in 2015, and you were already doing great as an individual investing for your own portfolio. What was it that caused you to want to expand beyond just personal investing to help others create wealth through property investment?
So at the time, I was just helping a couple of like friends and family, like direct ones. Like I was doing, like I mentioned, MBA. So there's a couple of, I guess, when you're with people, you tell people what you're doing more than you normally would. And eventually it, came out like, I'd tell them I invest in property a lot. And like as soon as you mention like how much I've done or whatever, like they're instantly like, oh, can you help us find a deal like what you found? So I started doing a few of those, and eventually like the word of mouth started to spread. And then I just started like charging a small like finder's fee for deals. And then before I knew it, I was doing like 2 to 3 of these a week, and it was becoming like a serious thing. So I then made a business. So it was an accidental business. Like there was really no long-term vision at that point. It was just I was trading my time for a service at that point. And then I was in like one of those old magazines and articles. Like there was a major kind of article that went out about 10 years ago, and it was like the number one article on the day in Australia and New Zealand. It got translated into 20 different languages, and we had thousands of inquiries off the back of that one article. We had a lot of hate off the back of it too, because they're like, oh, look at you, property investors. And like, because it's a very polarizing topic in Australia. I'm sure it is in most countries. But that kind of just meant we either had to shut off completely or scale up, and we chose the latter.
So tell us more about exactly what you do for your clients. You mentioned the situations that you did early on where you were charging a fee, a finder's fee, and you're actually doing a lot of those. A couple of weeks sounds like a lot of deals. But today, are you teaching people to invest on their own, or are you investing in deals that or are they investing in deals that you find and you manage? Do you have a fund, or what does that look like? What are the different ways that you help your clients?
Yeah, so I'll try and go through the whole value chain really quickly. So started off finding properties. So basically we help secure properties. We do all the negotiations. We do all the due diligence for an individual client. They'll have their own budget. So our average purchase price might be somewhere 2 to 3 mil for a client. We do deals all the way up to the 20, 30, 40 million, down to about 500,000. So there's quite a large range there. Australia and New Zealand at this point will eventually go into other countries when we see the opportunities. But right now, I can't see any markets that are presenting better opportunities from a capital growth, a risk point of view, and a cash flow point of view than Australia and New Zealand right now. So hopefully that changes, and we'll move to those markets when it makes sense. But in terms of the value chain, we find properties and then we help them financing it. So we've got Rethink Financing, which is one of Australia's largest commercial financing arms. So basically it's money for commercial properties and residential via the banks and private lenders, stuff like that. Got an insurance business because a lot of these big properties are very hard to insure. Like if it's a cold storage facility in an area that has never had a cold storage facility, like you can't just go online and get this insured. You need someone to survey it, and you need to get proper quotes from specialists. And so we've got that business as well. We do educate a lot. We've got an education platform. We've got the podcast, which is free information. The books and podcasts are almost like indirect lead generators, but we'd never sell anything. If you've read the book, it's pretty much just, here's what it is. Do you like it or not? People do what they want with that information. Some will buy by themselves. Our big value proposition is we like right now we're purchasing 60 to 75 properties per month for clients. So that purchasing power gives us really good networks, and that's the secret sauce. Like, it's almost like inside trading legally. We know who's selling properties. We get them off market. There's no competition for the majority of these deals. Even the ones that are listed on portals and stuff like that, we probably know the agents and done 10 deals with them. And that gives us a competitive edge because they know we're a verified, genuine buyer. So sometimes they'll accept offers from us below others because, a lot of these deals will crash due to finance, or maybe the buyer didn't know what they're doing with due diligence. And we're a sure thing, and that's a good thing in this industry. More parts, like the newest business, there's a couple of new ones. Like there's 8 in total. We are launching a fund management business, which is like licensed back, and that's holding money for people, giving them a return. That's larger assets again. The renewable energy one's probably the most exciting one at the moment, which is essentially putting solar panel and battery storage on these large roofs of shopping centres and industrial properties, and we sell direct to the tenants. The tenants benefit from this because they might save 20 to 30% off the mains grid. So it's green energy and it's cheaper for them. So there's a win there. The landlord themselves will win because we're paying a lease roof value. So there's a roof, and they can't monetize that normally. But like if we come there and say we're going to pay for the solar panel and battery storage, it might be $1 million investment, but then they're getting a rent for like a 20-year lease on a roof, and then they could use that lease to, I guess, increase the cash flow on the investment. When you increase the cash flow on a commercial investment, you create equity because you've increased the net income versus the cap rate, the capitalization rate of that market. So you're actually getting free money, and like not only in cash flow, but also from equity value as a landlord. And then us as a company, we benefit because there's a margin on the power that we create, even after we've discounted the tenants on their mains bill. So the only loser in this case is the actual mains companies, those large, I guess fossil fuel or whatever companies out there could filling the grid up. So that's a really capital intensive business. That's its only problem, because every time there's a new job, you've got to come up with the capital. But it's an exciting one, and that's basically, again, it's helping investors. So we met on Richard Branson's island. Like, I guess he inspired me a lot with the Virgin businesses. It's very similar, but we're obviously more in the financial division. So the Rethink business, it's all about kind of having a model to helping a client financially. So we're more in the finance game, and our method is property, wealth, and obviously that can go up and down the vertically integrated business model quite easily.
Well, and you've done a great job of that, and some of the businesses that you've created are natural growth, so financing or legal or insurance. Renewable energy is a little different, but certainly related, and I can see the connection. I wanted to ask you, you mentioned Virgin, and in our first conversation, you talked about your intentionality around uniting the entities under a single brand, like, as you just said, Richard Branson has done with the Virgin brand of companies. Scott, why was it so important for you for every company to have the Rethink brand in its name? And what are the benefits from that type of naming convention?
Look, the two major ones are one, to help manage them better. So they were growing at different rates. Like, we might find financing grew 250%, but then the Rethink investing business grew 130%. a lot of them are so directly connected that if one grows too quick, the customer experience will drop in the others because the lead flow between them is significant. And that's probably the other benefit. Like clients trust the brand. We've been around for a decade. Trust is huge. If we have some random insurance broking company that no one's ever heard of, they're just going to start again and look for their own referral source. And I guess, it's trust is probably the main thing. And we've taken, as you mentioned, like 5.8 to 6 billion in transactions to get that trust. And I found business got a lot easier. Probably from year 5 or 6, business got really, I wouldn't say easy, but compared to the early days when no one trusted what we did, life's very easy now, and we're doing much higher volumes, a lot more staff. But we're just doing the right thing by people, and the clients, they work with us so much easier now.
Are clients coming to you in different ways? So early on, it was all about real estate investing, and then again, you got into insurance and financing and legal. Are clients coming to you for legal work and then getting into other areas, or coming to you to insure properties and then becoming more involved with you that way? Or does the funnel still work the same way it did originally?
Great question. And look, it comes from all aspects. So, legal, for example, they do all types of law, from family law to, dispute resolution, construction. So, conveyancing and just commercial transactions are only a very small part of what they do. So, if someone comes in due to some pharmaceutical law type thing, and all of a sudden they might go, "Oh yeah, you're part of Rethink Group. I'm thinking about buying my next pharmacy. Let's talk on that." So it can come through any angle like that. Some businesses are more lead catchers. Like insurance is like the last on the line. Like, once you bought the property and done everything, that's kind of the last step to finish the transaction, so that you're probably not going to get many referrals back to the top of the funnel that way. But we get our leads from podcasts, through word of mouth. Word of mouth is probably the major one now because of 5,000 plus clients over the years. So a lot of them are coming back for their second and third, or in some cases up to 15th property with us. And they're it's word of mouth, and then obviously all the usual stuff, social media, Google and the stuff like that. But it's a lot less influential than the previous methods I mentioned.
I didn't realize that your legal business branched outside of real estate. I was thinking that it was really supporting real estate transactions, and obviously it does that as well. Talk about the newest company, Financial Planning, and is that another example of where financial planning will include, say, equities or alternative investments, Bitcoin or something like that, in addition to real estate? Or did you create the company primarily as a support structure for your real estate clients?
So good question. Again, it really is to help give holistic wealth advice. So a big problem in Australia with the financial advice industry is they do not recommend property at all. So it's purely insurance and stocks. And there's maybe 1 to 5% of planners that actually look at property, let alone commercial property. That's so far from their bucket of knowledge. You couldn't get further from it. So we created that for proper advice. So it's a different business model. It means they're not getting kickbacks from insurance or just giving equities advice, because you need a bit of everything. Like this better than anyone, Brian. Like, you have to have a little bit of it. Like, you got to diversify. You don't only buy commercial property. Even if I think it's the best investment in the world, that's not what you do. You need to have a residential, some stocks, chuck some Bitcoin and other alternative investments in there. And that's where the advice might actually contradict what we're doing with commercial, because we don't want someone to go into commercial if they're not ready for it. So it's protecting the client at any cost. That's the idea. So it's been a really popular service. Like, we only launched it a couple months ago, and it's booked out 4 months in advance now. So the trouble with that business is just kind of scaling it to maintain the same level of advice. And it's very hard to find staff for that business because no one has that holistic knowledge. And we've got a few people, but yeah, we're going to have to train them from the ground up. That's the way to fix that business. Like, you can't put it online, a job ad, and say, we need someone who can advise you in stocks, Bitcoin, residential and commercial property. They do not exist in Australia. So we've got to train them. So that'll take a bit of time.
And then how do you market that company? That sounds like more of a retail product than, say, getting commercial real estate clients.
Right now, there's really very little marketing. We just did one podcast on it, and that filled it up for 4 months. So we're going to have to put it in the background until we fix the operation side. Otherwise, it's just going to create waiting times that are just going to cause, I guess, disappoint customers, essentially. Yeah,
sure.
So,
well,
yeah.
The good news is if you do one podcast and you have deal flow for 4 months, and it's a pretty good idea, right?
Yeah, and that's sort of the foundation of every business I've run. Like maybe that's my engineering brain. Like, we've got a good product in every department. Like, the product works. It doesn't need to sell itself. You still need to sing from the hills a bit and get the word out when there's a business, but the products sell themselves. And that's, I guess, different from a lot of sort of other entrepreneurs that I see out there, which, like, they're more marketing first and then they create the demand, and both methods work. But I sort of believe in the product first and marketing second, and that's sort of why maybe I haven't had a failed business to date, just because these things, even the first business, like, I was doing cash jobs without a website, no business card, like, the product works. All the other stuff just kind of, that's 10%, benefits here or there in terms of revenue. That's how I look at it. So every business must stand on its own 2 feet, without a website, without a business card. And if you can do that, then you've got a good business.
Well, it sounds like it's been very organic over the 10 years.
Yeah. And like, we're sort of achieving on average 30% year-on-year growth every year. At some point I was thinking of, like, listing it on the stock exchange in 5 years, and I've recently thought, what's the point? Because then you're losing control, and then you've got to report every quarter. And I guess life's in a really good spot where the business is growing. And yeah, it's just sort of, you don't need to make your life more difficult. And that's maybe something that's changed in myself in the last couple of years, because we could have just gone for even more growth, but then then your product gets diluted a bit. Like, scaling, you can't scale all the time in every business. Like, there's a limit to the amount of good properties out there, or the investments. Like, so we need to keep that in the back of the mind. In case we get 10 times the size, we've got to be wary of how to create that growth, and it's probably going to be other countries and other businesses.
I was thinking about that as you were talking about expanding outside of Australia and New Zealand earlier, that wondering, and I have no idea, it didn't seem to me that this would be the case, that at some point deal flow not dries up, but slows down, especially with the way you're scaling. And do you think that's what's going to, you mentioned really absence of opportunities on the level that you have in Australia and New Zealand as a barrier right now. But do you see that happening, where the rate of deal flow will cause you to look outside of Australia and New Zealand?
Yeah, look, it's our biggest business problem right now, the amount of stock. So in the entry-level price points, we have over 6 months of waiting periods just to get a property. So it's not as long if you've got a larger budget, because there's more deals out there, and obviously the more you spend, your heads get above the clouds in terms of competition as well. So commercial and even residential, it's a great place to be for a larger budget client or a family office or a fund, because you can pick and choose a lot better. You get better yield, better growth, or lower risk. Everything kind of works. But the entry level price points, it's very difficult because we maintain a certain level of quality that others may accept lower than what we do. And if I brought that barrier to entry down, let's say we accept lower yields around the country, we could increase our business revenue significantly. for the following few months after that, because we've got all this extra stock to choose from. We'll pile them into the basket, and they'll get, allocated to clients. But if we did that, that's a short-term strategy of ruining your reputation. Yes, you'll make more money because you've got all these deals, but then you've just overpaid on hundreds of deals. Those clients will eventually work it out. You haven't invested well for them maybe a year or two down the track, and then you're finished from a reputational point of view. So we did expand to New Zealand for that reason, because it was cheaper. Identified that market of having a much better opportunity than Australia, actually, because their interest rates went a lot higher, their prices fell more, and we were buying like at a 30 to 40% discount from peak prices in 2021, in 2024 and 2025. So, we're buying at a discount rate. So that's been a really good pocket of investing. And always looking around the world at other opportunities. It's harder than you think, because people want to lend, like especially if you're putting 30% cash down and the bank's lending you the other 30%. Your return on that 30%, return on equity, should we say, is very good in Australia. You're looking at anywhere from 15 to 35% return on equity, and that's without doing a value add. That's just growth of 7%, leverage. Like, we can break the numbers down with a spreadsheet for your clients if needed, but it's good returns, and they're low risk returns for that amount of upside. And the reason for that big number in return is just the leverage factor. It's amplified because you're putting less down. So if an Australian goes to the US, we almost can't get a loan in most cases. So you've got to put 100% of the cash down. It's not going to give you that return due to the amount of cash you've got to put in. So you don't have that amplifying benefit that you would. Lots of parts of Asia, like the good markets, are terribly low yielding. So many parts of Asia, you can't own the land as well. So there's problems there. Europe is struggling in many parts. Like, I bought a property in Greece. Again, it's a cash situation. You can't get bank loans, mostly as foreigners. The income side of things is extremely difficult to achieve there, because tenant rights and also things like Airbnb are limited in terms of how much you can sort of rent out per year. And there's further restrictions coming as many local councils, local government areas crack down on that. So I don't know, there's a whole lot of risk everywhere. And then you see Australia and New Zealand, and it's almost too good to be true. So maybe there's parts of the world I don't know about. But yeah, we don't want to go into the full third world country hoping for all out growth too, because it's just a bit too scary for us as well. So
sure.
We're always looking though.
How do you stay disciplined in your investment approach, especially when deals start to dry up? You mentioned not wanting to overpay, not wanting to buy properties that end up in lower yield, and so how do you maintain that discipline?
We're upfront with clients to say the waiting list is now very long. So yes, you can sign up and wait with us, but it could be 3 months, could be 6 months, could be 9 months. We've got alternatives. Here's New Zealand. We've launched in the fund Rethink Capital for this reason, so you could just put a smaller deposit in a larger asset. So just creating new products, I guess, for them, because we know that they're going to go somewhere else. Like, there's always another advisor out there that going, hey, yeah, we can get you a commercial property, and they might think it is a good deal themselves, but in our eyes, it's not, because they're paying too sharp of a yield on it, or maybe it's too regional. I don't know. There's many reasons why a deal may not be good, but I'd rather not have that on my books, because a bad deal, like there's this old saying, like you're only as good as your last deal. So if we do a bad deal, like everything we've done before, like we've just ruined someone's life potentially, or set them back financially many years. Or for what? For a small fee? It's just not worth it. I'd rather them late. I'd rather them not go somewhere else. So we've got the alternative products there, but it's a battle, like, because there's a lot of impatient people that want in, and we just have to maintain that discipline, as you said.
Yeah. Well, it sounds like you do a pretty good job of it. I want to switch gears a little bit, Scott, and it's clear that you're a brilliant real estate investment strategist and property manager, but leading the organization that exists today requires a very different skill set than buying real estate or managing properties. What shifts did you have to make in your leadership style to be able to manage people and teams effectively, especially that you're trying to maintain such a strong organizational culture as you scale your companies?
Yeah, it's a good question. And look, it's one I haven't put a huge amount of thought into. So, in terms of, I guess, leadership, my style is empowerment of others. So, I trust a lot the other people under me. And to the point where, like, we just hired another senior manager. And I said to him, look, I probably won't come to you. You come to me when you need help. I'm always available, doors open. This is yours. You do what you need to do. Like, we're not sitting on thin margins or reporting to stock or shareholders quarterly. So if things go a little bit wrong through to someone not doing their job, I'll live with it. It's not a stress for me financially. The patterns are, but you can recognize the patterns quickly, and that's, well, not quickly rather, but then you can sort of step in and go, all right, you're not doing good there. Like, what do we do to turn that around? So it's not really, it's quite sort of long-term reaction based, I guess. But yeah, we've got really good people working here. The staff generally have the freedom in most cases to do what they want within reason. And then if they skirt outside of the culture of the company, like, we'll come down pretty quick on that and try and remove them in any way we can. But yeah, it's really just people, they know what to do, and yeah, hire the best people we can. And we are lucky in this industry because I guess a lot of the buyer's agent world, that it's a new industry. A lot of people want to get into it. So we do have like multiple resumes come in almost daily. We'd get a resume sent to us. So there's always something to look over, and you hire for culture rather than resume. I think you just get a good feel with someone, and they're going to learn on the job here. This isn't a business that's been around for 50 years. So, we're an industry for that matter. So everything they learn is going to be unique to this company. So it's about them, not what they've done in many cases.
Yeah. What are the biggest challenges that you bump into either as an entrepreneur and or as a leader in your companies?
The biggest challenge would probably be, like I mentioned, just keeping the quality of the stock up. So that's more operational. In terms of staff, like, it's been pretty good. Like, there's always that one staff member that kind of just gets jaded. And one of the biggest mistakes I've made in my life is just putting up with it and letting them kind of sit and sour within the company, because one sour person can influence at least 5 people around them. And that's what they do. When someone's, that old saying that misery loves company, and they find who else is sort of misery, and they all start talking in the background. And a lot of the time I'd just kind of like let that slide, because the things are going good. They are, like, it's almost like a little tiny bit of damage they're doing in the background, but the ship is sailing well. So let's not muck around with it. But in recent times, it's when those people have left, we've actually grown a lot quicker. Like, all the other people lift, the negativity goes, and it's always around that individual as well. And yeah, so I think not moving quick enough has been something, because I'm pretty relaxed as a guy in general too. So I can relax my way through problems too in that case. But just dealing with it quicker is something that has been very beneficial in the last couple of years.
I don't think people ever think that they let people like that go and too fast and freed them up to pursue their next opportunity, right? We always, typically, most of us tend to take a little bit too long, and everybody around us has known that it should have happened maybe before we know.
Yeah, and like, it's pretty much everyone's least favorite part of running a business, like, the staff, but not like the bad side of staffing. When you got to even if you really don't like the person, letting someone go it's horrible. There's nothing good about that. And especially in Australia and New Zealand, like it's very difficult to do that. So you got to be prepared. You can't just sack someone. You got to have like, pages and pages of legal backup, and you got to understand the exit strategies. And like, so you don't just go in like what I would do with 95% of my meetings, go in unprepared. You actually have to prepare, which is a shock to the system, because it's not assumed knowledge. It's like, well, this specific case has these specific rules, and you've got to then say it in that way. But once it's happened, it's like the best thing ever. It's done. Company benefits. Everyone's happy around them.
Well, and what I always come around to on that, and you're absolutely right about what we have to do in advance of taking the inevitable action. But what I come around to is that it's the right decision for the organization, and everybody in the organization knows that usually. And it also frees that person to go pursue their right livelihood somewhere else. Because if you're not happy with them, chances are that they're probably not very happy either with you or with what they're doing or with your organization. And so the sooner we can free them up to go pursue something else, something that they will be happy doing, the better all the way around.
Yeah, it's definitely for the greater good. And you're so right. Like, one of my old bosses used to say, like, he was a very forward, like old school type. He said sometimes it's best just to let them know that maybe you're not happy, or they're not happy with the company, and it's best you go. Like, this is almost something before you get lawyers involved. Like, just say, no one's really happy with how things are going around you. Are you happy? Probably not. We can see it. Like, have a think about what's best for you, and just gets them in that mindset to potentially walk on their own. Because you're right, they'll find something better. Like, that people get jaded with a business for whatever reason. Maybe the company's grown quicker than they have, or maybe this internal competition they don't like, or personal issues with direct managers or whatnot. But like, these problems don't exist in every business, so you just got to find where the glove fits better somewhere else. And staff stay too long too. It goes both ways. Companies sack too slow, and staff linger around a little bit too long as well, and that it's not good for them. Sure.
Well, it's comfortable. Scott, one of your core values at Rethink Group, and this is one that really resonates with me, is excellence. And of course, our show is called LifeExcellence. So I have to ask you, what does excellence mean to you?
Just the freedom to do what you want when you want. I think like, from a happiness point of view, I've never been happier in my life, in terms of there's no weight where it all started with the financial side. So you sort that out, and then it's not just that, because most entrepreneurs then bury themselves into 15-hour work days, 7 days a week. And that's where I was for almost 10 years. But take the step back and be a bit more strategic from a decision-making point of view, not just on allocating time, but also, I think I grow this business more efficiently with less effort. And that gives me a lot of, I just feel like life's gone really well for that reason, and touch wood, it keeps going like that. Because it's not all about just digging as hard as you possibly can, because that's a lot of the mindset out there of entrepreneurs is just outwork people. And I definitely don't outwork my competition, but I think we do outsmart them in terms of building better business processes, scaling in certain areas, using people and processes to kind of overpower the individual's effort. And I think that's probably what excellence is to me, just living as efficiently and as happy as possible.
That's great. And Scott, I know work-life harmony, if I can use that term, is extremely important to you. And so really continuing on with the thought that you started, I know the demands of your business continue to increase as you scale your companies. You said that you're not working as hard as some of your competitors, but I'm going to push back on that a little bit. And you have 8 companies, you're growing, you're scaling, there's a lot of deal flow. There are definitely demands on your time. And yet I know that your personal life is important to you, your family's important to you. How do you balance ambition and contentment growing a thriving business empire while also living a fulfilled life outside work?
Look, it's just setting boundaries. So in terms of, I guess, the business setup, like, again, really trusted people that I can trust that run those companies, and I don't need to interfere too much with the day to day. So quite high level approach to that side of things, and they're all invested in it as much as I am. And yeah, just setting boundaries. So like, I'm not going to talk to people on weekends about work. Even if I get someone wants to chat desperately, on the weekend, I just try to keep business and property outside of those chats, because it is all consuming. And I get approached in the street every now and then wanting like free property advice. So I'm happy to give that. That's no problem. But yeah, I remember in the early days, you bring work home and you talk work nonstop, and then your mates want to know what's happening with work, and then you take a client call at 9 p.m. at night because they're overseas, and all of a sudden you're doing nothing other than working, and you think, well, what was the benefit of all of that? I grew the business 0.5% more that year because of that extra effort. That's just ridiculous when you think about it. Instead, close that side of things, and then I feel like I've got a lot more free time than you'd probably realize as well, because boundaries are set. And then you did even small things shorter meetings. Don't have an hour-long meeting, have a half an hour one. What do we need to sit in there for an hour and just chat for? If it's to do with a simple business catch-up, all those little decisions do make a big difference at the end of the week.
I think our listeners and viewers hear you say that, and they want to know more because they want that. Maybe they want that even more than financial independence, creating boundaries around their work life and their personal life. And you make it sound so simple, and you've actually done that through the show. You make commercial property investing sound, and I know you don't intend to, but you just make it sound so much easier than I know it is. And probably the same with these boundaries that you talk about. It seems like, just generally speaking, I'm assuming in Australia, New Zealand, it's the same as it is in the U.S. We're pulled, the boundaries between work and personal life are blurring, or maybe non-existent, certainly blurring to more than ever before. So how are you so fastidious? Does that go back to your engineering background, that you're able to just stay so disciplined in creating those boundaries that those lines don't get blurred? What's your secret?
Well, I don't think discipline comes into it at all, because when I was taking every single thing on board, it was because I wanted to, and now I don't want to, because I've reached a point where it's like, all right, well, like I mentioned, we don't need to push 10 out of 10 effort, because it's not going to really change the outcome of my life or even whoever I'm talking to's life. So it sounds, the simple thing is, I'm just doing what I want to do in that department. It's almost like I don't need to put in rules. I've just got to be comfortable saying no. And if you're cancelling a meeting or pushing one back a month, it's not because it's almost you feel guilty doing that. That's the early days. Or you might think, I'm going to delay revenue because I can't do that deal as quick. I've got 3 or 4 business proposals on the table right now that people want to start businesses with me, and I can't do it because it's going to overlap with other ones, and it's just going to start making the whole thing a mess again. So there's a bit of strategic in there, but it's for the greater good. But yeah, I think everyone's at different stages of life. So it's simple for me because I'm at a stage now that I'm content and happy, and no doubt the goalposts will change in time, and I'll probably want to go harder or at some point. But just listen to your body and your mind, and do what feels right. And this is what feels right at this stage. And I'm still working very hard, but I'm just not taking on extra things that are going to make it less enjoyable. Because the most unhappy I've been is when I've been overworked, and that's where you start making mistakes. And instead of, you just treat people different around you as well.
Well, and so I mentioned discipline, and maybe I was wrong about that. Maybe it's about clarity. It sounds like you're crystal clear about the life that you want to live, and then you just do what it takes to build that life around you.
Yeah. So like every year, like I might set 12-month goals, or think in 5 years, where do you want to be? And in 5 years, like where I want to be, it's pretty much doing what I'm doing, just with the natural growth that comes out of it. Like a lot of people. I was talking to someone I was playing golf with the other day, and it's like, oh well, your businesses are, they're not the biggest in the country. And I thought, like, I said, why would I want them to be? Like would that change? That means I'm going to have to fly around the country 10 times long, reporting to shareholders, and all for what? To get an extra zero on the end of the profit. Like, what am I going to do with that money? Or even list it on the stock exchange. If I sell 50% of the equity in the businesses and I've got this giant chunk of cash, what would I do with that cash? I don't want a yacht. I don't want to buy another 10 properties. Like, it's useless to me at some point. The freedom is more important. So once I've got a lot of people want that. If you want to buy a $500 million yacht, go for it. That's what you're going to have to do. You've got to keep taking it on, and that's the next level stuff. But that doesn't interest me. Materialistic stuff is really so far from the vision that it's not funny.
Yeah. That's great, Scott. I really appreciate you sharing not just the last part, but really the entire show. It's all been great, and I really appreciate you coming on the show. It's wonderful to see you again, and thanks so much for taking time out to come on Life Excellence. Appreciate it.
Great to see you again, Brian. Good to see you, and catch up again on Necker Island, hopefully.
Look forward to it. Thanks for tuning in to Life Excellence. Please support the show by subscribing, sharing it with others, posting about today's show with Scott O'Neill on social media, and leaving a rating and review. You can also learn more about me at brianbartes.com. Until next time, dream big dreams and make each day your masterpiece.